Thanks for coming. I'm the Mercenary Geologist. You can find me those coordinates. We have 47,600 Twitter followers. Here's the disclaimer. Nothing I say today can be construed as a buy-sell recommendation, go long, short any financial instrument. That's not me. I just tell you what I do in the market. So we're going to talk about the seasonality of gold right now. Gold 'tis the season, and I've named it that because the buying season in gold starts right after Christmas. And we'll show you this in a series of charts. So the seasonality of gold. So I have this massive Excel database, over 90 megabytes, with 1.3 million data entries and derivatives. We have gold prices on a daily basis since 1968. We have gold prices since 1792. We have Dow closing value since 1901, etc. So what we do is we compile daily price data, index data, economic data on many, many commodities, fiat currencies, production, commodities, etc. So what I've done over the years, and this thing's been going on for a decade now, we start to see annual price patterns in year-over-year trends in gold. And so the first thing we do is we normalize the beginning of every year, and then we start plotting gold's trend. And we do this in 4-year time frames. And what we found, this is 1970 to 1922, January open of gold on a yearly and December close with a percent change. We define bull markets as anything greater than a 10% rise in gold. We define bear markets as anything greater than a 10% loss in gold over the year. And then neutral years are anything less than plus 10, greater than minus 10, so that 20% range in there. Then we've color-coded on this chart the bull years in green, the neutral years in black, and the bear years in red. And in a 53-year period, folks, since 1970, when Nixon took the U.S. off the gold standard, we have had only 7 bear years. So we've been in this giant 53-year bull market for gold with only 7 years down significantly. So what do we do with that? Then this example how we normalize it. So we do it in 4-year trading blocks because it gets too messy and you can't see the yearly trends if we put more. So we've got 18, that's not right, 13 of these 4-year blocks. This shows 18, 2019, 2020, 2021. And you can see in those 2 years we had 2 really nice bull markets for gold, somewhere plus or minus, let's say, 20% rise from the beginning of the year to the end of the year. Those are both bull markets. And then we have a couple of neutral years where we're negative, but we're less than 10. So we put all these normalized charts together, and we come out with a composite chart. Before I get there, I jumped ahead of myself. This is what 2022 and 2023 have, what 2022 was, what 2023 is shaping up. So it shows you how we construct these charts interactively. That's the same, that's 2022, and in red is the rise so far in 2023, and put all this together, you get a yearly gold price trend, 53 years, And you can see a couple of things on there. Year over year, from start to finish, gold on average has gone up about 10.5% a year. You can see some trends in that, and if you look from day 1 to 43, and then days 232 to 253, and these are trading days, folks, so each 21-day period is construed to be a month. We have to do it this way because you got Fridays and Saturdays and holidays, and they don't occur on the same day every year. So we do it by trading days. So just look at every one of these blocks on the x-axis is 1 month. In particular, let's look from day 232, which would be about the 1st of December, and we go almost to the end of that, and you see that spike up in gold. And that happens after Christmas, between Christmas and New Year's. And then if you look the following year, which would flip over to day 1 in January to day 43, more or less the end of October, you see this big run up, and you add all those together, and that tells you that's a good time to take profits in gold if you want to trade it. You don't want to buy it. So when do you buy it? Well, you can buy it in March to May when it's flat. You can buy it in the summer doldrums, which would be somewhere about day 110 in early June through the middle of August or so. But so then what we do is we start breaking this down. So we go from 1996 to 2022, which covers about 3 complete bull bear market cycles. And we get 11 bull years, only 2-year bears and 14 neutral years. But look at the returns generally on the black. We've got some positive years in that. So only 2 bear years in the last 27. And that gives you this trend. And once again, let's look at the beginning of the year and then at the end of the year. So you put those together and you've got that big rise. So on the seasonality then, which is really the gist of this, we've got intra-year price patterns and trends. So we do it the same way. We normalize trading bases. We do it on seasonal timelines. We compile our 4-year composite charts. We put all those together, and we tabulate bull, bear, and neutral market years. Then we plot long-term seasonal trends. And we've tried a variety of things. We've been doing this for since 2015, 2014. And we figured out that there's some seasonal trends from November to February, the end of one year, beginning of the next one. Then March to May, we break it down June to October, so we take in the summer doldrums and the Indian buying season, and then we kind of put it into a big movement chart from June to February. I'm going to show you those charts. So this is the seasonal price trend over 27 years in red, and in black is 2022, 2023, current, what's going on. But notice from about, it would be about day 250, which would be right before the turn of the year. That's around Christmas. And you see this 5% rise in gold till the end of February. So, and that's where we are right now, is in this period where we, year after year after year after year, about 8 out of 10, 9 out of 10 years, the price of gold goes up during this period of time. You don't want to buy right now. If you're selling gold, it's probably a good time to sell it. But I don't sell gold, I hoard gold. So then we have a seasonal price from March to May, and this looks noisy, but I want you to pay particular attention to the y-axis. It goes from 0 to -1 to 1%. So that tells you that the price of gold is basically flat, and it ends up flat. It starts, we normalize it at the beginning of March, and we do that through the end of May, and gold is flat. So that's the quiet time. Then in June to October, you can see this summer doldrums. So the 1st of June would be about day 106, and gold is basically negative until day 148, which would be the 1st August. So this is the buying time for gold. And what I do is I have target prices for gold. If it gets down that far, I trigger a buy of physical gold at oftentimes the yearly low or close to it. Then we have a little run up. If you go to about day, what would it be, 180 or so, that's Labor Day, and you start to see this big rise in the price of gold, and that's the Indian festival and wedding season. So there's great demand for physical gold. Drops off over that after that by about mid-October, and if you put all those two charts together and do a June to February, you see once again about day 245, day 250, this big bump up in the price of gold. We've overlain 2022, 2023 data over this in black, and gold's been very volatile. It hit interim lows the end of October, but look what's happened since then. And amazingly enough, look where it is right now. And this is as of Friday, and it's hit the annual trend line. So with all this noise and volatility, right now we are still only up average what we generally are over the last 27 years. So this tells you, for us, it becomes, when do I buy gold? And I hoard gold, so I don't sell it, but you could also do the sell thing. So once again, yearly price trend, we've already looked at this slide. That's just kind of a review. So how to profit from the seasonality of gold? I've told you how to do it. Now I want to put it in print. The annual return over a 27-year period on the price of gold has been up 6.5%. So you can buy gold at the beginning of the year and on average sell it for a 6.5% profit. Better yet, you can buy it during these dips, during the summer doldrums, and hold it less time, say 6 months, 7 months, and make a better return. From December 25th to February 25th, and realize these days are somewhat equivocal because we operate on trading day basis. You got a bull run that's essentially up 5% every year. March through May, quiet time when it's flat. The buy time for me is on dips from late June to early August, and sometimes those dips are 1 day or 2 days where it will hit its seasonal bottom or yearly bottom. I'm poised. I've already talked to my guys that I buy physical go buy, and we trigger that buy. Labor Day to mid-October, we've already talked about that. The reasons for this uptick, it's really physical demand from India and somewhat from China, but a lot of physical demand in conjunction with the annual wedding and festival season in the subcontinent of India. And then October 25th, flat. So kind of sums it up briefly. And I'm going to tell you right now, I'm very bearish on this junior sector. I've been bearish for well over a year. During the run-up in summer of 2020, when the price of gold went way up and all the money was piling this sector, I was taking profits. We made really good money and contrarian philosophy, you're selling when everybody else is buying. So what I've done here is we've done a 12-year record of the price of gold going into early 2020, 2023 versus the Toronto Venture Exchange. And you got to look kind of tightly at this, but generally what you see is similar patterns. But I would make the case that the price of gold generally front runs the rise of Toronto Stock Venture Exchange. And I've said this for years, gold controls the junior resource sector. The price of gold goes high, and back in the day when Ed McMahon came on the television and told you to buy gold, people would start piling in, not only to physical gold, but this sector. I think that's what's going to take, a sustained high, new high for gold, 2063. If we can get up there by the end of February and then hold through that flat period, maybe some interest will come in this sector. Look at Toronto Venture Exchange volumes over the last 6-9 months. They are at record lows since 2003, 2004 in the nascent part of the Toronto Venture Exchange. Back then, there were a lot more companies in this sector, but they only had 30 or 40 million shares out. You can't find many with that few number of shares. So we have a liquidity problem. Until we solve that, bring the generalist investor, generally Americans, back in the market, we're going to have a bear market continuing in this sector. So gold is money, duh. 53-year bull market with only 7 bear years within that, defined as a minus 10%. And, a lot of people call that correction. Well, we call it a bear year. We don't go with a 20% as a bear. So if you take in inflated dollars, the price at the beginning of 1970, which was nominally $35 an ounce, right before Nixon took us off the gold standard, and in inflated dollars, it went from 35, and we did this through the end of the year, so that was 1812. That's greater than a 50 bagger. At 1920 or whatever it is today, that's like a 55 bagger on the price of gold. But you've got to factor in the CPI, because inflation's eating in the dollar all the time. So we went in, and from our database, we took year-end CPI numbers for since 1970. The U.S. dollar in 1970 is worth 14.6 cents, basically 15 cents what it was then. And so that's basically a 7, divide it by 7, and you get, in constant dollars, from 1970 to 2022, gold is returned in real value terms a 7-bagger. It's gone from $35 an ounce to a constant dollar value of $264, and that, in terms of purchasing power, is a 7-bagger on your holdings of gold in 1970. If you couldn't even buy gold till 74. But what I'm getting at, it has retained its purchasing power and a lot more, folks. What do you do about it? For me, physical gold in my possession. Use it as safe haven insurance policy, a hedge against economic calamity. Next, I'm going to show you what the world's longest lived rich families have owned since the Renaissance. They've owned gold. This is a pan of nuggets from the Tofty deposit near Fairbanks, Alaska. They've owned farmland. This is a photo from my hobby farm in New Mexico showing Wooly Bully, the big bull, and a couple of my beef cattle. And they've owned fine art, and you probably know of this. This is Hieronymus Bosch, and on the left is heaven and the Garden of Eden. In the middle is earth, and on the right panel is hell. So I own 2 of the 3. I don't own any fine art, but it's not intuitively obvious, but that's what has retained its value since the Renaissance. Gold, farmland, fine art. Thank you very much. Free subscription on my website, mercenarygeologist.com.